So, good evening. I'm a tax accountant and the doors are over there. As well as tax, I've recently taken up marathon running. And my first marathon was the London Marathon at the beginning of this month. And running over the bridge was absolutely wonderful. And it started off really, really well. But after 26 miles, it does take a bit of a toll. But it's a really wonderful experience, and I recommend it to everybody here this evening. I'm a partner at Mercy & Accountants. We're a local firm just down the road in Shrewsbury, and we specialise in helping landlords and property investors get more wealth and pay much less tax. That's what we do. And without being terribly boring about it, I'm happy to share lots of hopefully useful information with you this evening, but it is no substitute for proper advice from a professional who is familiar with your circumstances and can take lots of factors into account. So this is for information purposes and is not to be construed as advice. So what have I got in store for you? Well, I've got 15 minutes, but I'm certain it will seem like much longer. We'll talk about the Chancellor's recent tax changes. We'll talk about capital gains tax for those who are thinking of selling some or all properties. Some landlords are looking for an exit. At my firm, we're getting inquiries every day now from landlords asking about capital gains tax calculations. So I think those motivated sellers are definitely growing in number. We'll talk about some of the basic protections I think all property investors should have in place, and then we'll talk about your favourite topic of all, the most exciting thing this evening, which is making tax digital. Yay! So let's have a look and see what the Chancellor's been doing recently. Are we thinking about Rishi? Or possibly Nadine? Or possibly this chap, perhaps the best of the bunch we've seen recently, or this one, who knows? And I'm certain very soon now there might be another Chancellor. And we've had such a flurry of changes, announcements and reversals and re-announcements. I have to write emails for clients briefing them on tax, and it's an absolute bloody nightmare, if you'll excuse me currently, because it's changing all the time. So I'm not going to go through what the changes have been. I'm just going to talk about where we are now and give a very large health warning that this of course may change very soon. So if you're fortunate to have an income in excess of £150,000, first of all, well done, and secondly, the 45% tax rate is remaining. Those of us, and that's all of us in this room probably, who are hoping for a 1% saving on the basic rate of income tax, I think we can forget all about that now, and we might even see increases in the basic rate of income tax, but that's me speculating about what they might decide to do to plug the 40 or 50 billion per year black hole in UK PLC's budget. Anybody here is a contractor? You had a great time a long while ago. IR35 spoiled all your fun, and it's going to continue to do so. There's a little bit of relief about the size of firms where IR35 is decided by the employer, but I'll get past this because I don't think it's going to help many people in the room. And fortunately, the 1.25% national insurance increase paid by both employees and employers, so it's a tax on jobs, that's been cancelled, thank goodness. Now, many of you here this evening may already have formed companies for property investment. Hands up who's got a company with property, quite a few of you. And those who haven't yet may well want to consider that as a piece of planning. Now, we had the announcement of the 25% corporation tax from Rishi, and then that chap whose name escapes me with lots of Ks, he decided to cancel it, but then we've now uncancelled the cancellation. So we are going to have 25% corporation tax, but only for large companies with profits over 250,000. But the thing you have to pay a lot of attention to is those thresholds are for a company that doesn't have any other companies in a group, or where the owners of that company don't own multiple companies. If you've got multiple companies, it may not be 250,000 of profits before 25% tax bites. It could be much, much less, so please take advice on that point. Stamp duty, hurrah! We do like to stimulate the housing market, don't we? Because it tends to win to election successes, or at least it has in the past. It may not do so in the future, who knows? I've got lots of clients who've wanted to do tax planning, particularly married couples or civil partners, and stamp duty on mortgages got in the way, and the increased threshold for stamp duty, which has actually stuck out of all the changes, is going to be quite helpful. And of course, first-time buyers have got a much better deal now. My God, the energy prices. It's not directly relevant to property investors, but I think anything that's taking money out of our tenants' pockets is going to feed through into what we can realistically expect as rental increases. And where this goes, I don't know, but what was going to be a 2-year domestic energy support package is now scaled back to 6 months. And unless something happens to sort out the worldwide energy situation, that's really quite frightening. So as an accountant, I can be quite cautious, and that one really frightens me. And as if we hadn't had enough budgets recently, we have another one for Halloween, and I can guarantee there will be no treats in this budget. We all think, my colleagues in the profession, our professional bodies, we all think that there are going to be swinging government spending cuts. That's speculation, of course. And we also predict significant tax increases. It's not going to be good, but that's where we are. And we shall all know in a couple of weeks' time or less how that's going to shape up. I usually say there may be trouble ahead because I have to be cautious, but I think there is definitely going to be trouble ahead. And I think all taxes are at risk. The ones I've been banging on about for a few years now that have always worried me and colleagues in the profession is what will they do about inheritance tax, because it would be politically very popular to increase inheritance tax, although it collects a small amount of money compared to, for example, to VAT or income tax. And then capital gains tax. Why is it that capital gains tax rates are so much lower than the rates of income tax? An obvious move might be to align the rates of capital gains tax with income tax. So anybody who's thinking about an exit might want to think about what capital gains tax might look like in the future. And currently, when somebody passes away, there's no capital gains tax, but there is inheritance tax. But who knows what a future Chancellor might decide to do. They might decide that estate should pay capital gains tax as well as inheritance tax. But that's all speculation and being doomy and gloomy. Section 24, ouch. Section 24 has been awful for many clients. It has definitely driven clients flocking to form companies, despite some of the higher mortgage costs companies faced compared to individual investors. Section 24 is all about not giving you proper tax relief on your mortgage interest if you're a higher rate taxpayer. So what happens when we brought in Section 24 in a world of 2-3% mortgages, and we're now moving into a world of 6% mortgages? Section 24 is about to get really ugly. If you're a property investor and you're paying the higher rates of tax, Section 24 is about to hurt you a lot more when your mortgage costs increase. Limited companies might be an answer. So capital gains tax, how does it work? We all have an annual exemption, which is confusingly similar to the personal allowance for income tax, but it's actually a whole separate exemption. And if you are a couple, you each have your own exemption on which you pay no tax at all. If it's residential property that you've made a gain on, then the rates of tax are 18% if you have a basic rate income, or 28% if you are a higher rate taxpayer. It can be quite an expensive tax, but hey, you made a gain, so you have to pay some tax. There are reliefs available. And one interesting idea for planning is everybody thinks we incorporate personal property portfolios into limited companies to solve Section 24 and income tax problems. Sometimes we incorporate portfolios to facilitate a disposal. If I've owned a property since the good times of the early 90s and it's increased in value substantially, if I sell that property in my personal ownership, I pay tax on the gain that has accrued over the whole period. I also pay tax at 28%, so neither of those are a pleasant idea. If I were to incorporate my property business into a limited company before disposing of a property, point number one, when that company sells a property, it pays tax on the gain since the company was incorporated, not since the early 1990s. And point number two, it pays tax at 19% rather than 28%. So incorporation before disposal can be a good tax mitigation tool. And it's 60 days to pay your capital gains tax. You have to file the return and make the payment within 60 days of completing on the sale. It used to be in the happy days that we could wait until self-assessment tax returns and pay the tax then, but now it's 60 days or there are penalties. So it's good to be organised when you are considering listing a property for sale. Now, some planning ideas for spouses and civil partners. Sadly, anybody who is cohabiting, it's really unfair. You won't benefit from these planning ideas, but most years I arrange quite a few marriages when clients see what the tax differences might be, and the wedding bells, they do ring. So it's quite a common income tax planning technique, if you're a married couple, to change the ownership split between you so that it isn't 50-50. If one is a taxpayer and the other one is not a taxpayer, I think it's a much better plan to have 99% taxed on the non-taxpayer where they can pay naught, rather than having it split 50-50. And the same technique applies if the couple are paying different rates of tax. If one's paying 40 or 45% tax and the other one's a 20% taxpayer, there's a 20% saving to be had. However, if you've done that type of planning for income tax, and you really should have done, you do have to think about disposals, because you might want to own the property in different shares for capital gains tax purposes. So when you're getting ready to sell, you have to re-evaluate what proportion of the property should be taxed on each partner. So work is often required, and that must be done before the exchange of contracts. If you do the work after the exchange of contracts, it has no effect whatsoever. So if you're planning to sell and you're a married couple or civil partners, do some planning and speak to your accountant, or find a good accountant. A couple of complications to watch out for. Currently no capital gains tax between spouses, but if there's a mortgage on the property and only one of the couple is on the mortgage, if you take responsibility for another person's mortgage, even if it's your spouse or civil partner, that is consideration and stamp duty bites. But you might recall a few slides back, quite a long time ago it might seem, I mentioned the stamp duty threshold has recently been increased to £250,000. So I've got clients who wanted to change property ownership, but were stopped from doing so because of stamp duty costs, and in many cases those stamp duty costs are no longer present. And there's no 3% stamp duty between spouses, there's not been for many years now. Furnished holiday lets, this has come up quite a few times. Simon, who's probably in his taxi now, was quite a fan. He's thinking about the yield. I like them from a tax point of view because they get much more beneficial treatment for capital gains tax than long-term lets do. I can have rollover relief. I can sell my furnished holiday let and reinvest the proceeds in another business and not pay any capital gains tax at all. I can't do that with a long-term let. I can gift a furnished holiday let to someone I favour, and we can have gift relief, so no capital gains tax is triggered on the gift. You can't do that with a single let. I can get business asset disposal relief. That's a snappy term, isn't it, for a tax relief? Business asset disposal relief. I can pay 10% tax as a higher rate taxpayer if I can claim business asset disposal relief. And you can't have that on a single let long-term property or HMO long-term let property either, but you can on a furnished holiday let. I suppose the question you have to ask yourself is the property really suitable for conversion to furnished holiday let? It might not work on that basis, but it's always worth checking out. So let's come to some basic protections. What are the protections that anybody here with a property business should already have put in place? And we'll start off with wills. Sadly, on average, I have a client die a week. My clients don't have a higher mortality rate. They don't have a higher mortality rate than the average, but it's just the fact that people die. Death is part of life, and we have to be practical about it. Making a will means it's going to go a lot better for those that you care about, your loved ones, than otherwise. If your will is more than 5 years old, get it checked. A good will be tax efficient, so your loved ones will pay a lot less tax, and it will also be protective so that the people you wish to benefit from your estate will enjoy the benefits you intended. Wills are a template for probate. We act in a lot of probate cases. It's taking far too long and it's quite expensive. A good will is a good way to save on the costs and delays of probate, and we have to handle lots of inheritance tax. If you're a married couple and your wealth exceeds £1 million, unless you're a sovereign, bless her, Queen Elizabeth, your estate will be paying inheritance tax at 40% on wealth in excess of £1 million. Many people in this room, when you think about the death value of your estate, of course many, many years from now, because you're not my clients, in 40 or 50 years' time, what is worth now £500,000 could be worth substantially more. And it's 40%, it's a lot of tax. So, other basic protections. Lasting powers of attorney. A will, most people have heard of. It's something you make in lifetime to protect those you care about when you die, so it only works at the point of death. Lasting powers of attorney, the name gives it away, they last as long as you do. It's something you make in lifetime while you're well, and should in the future you have a knock on the head, a car accident, a horrible illness, something like that where your capacity is affected, it empowers those you have chosen, your loved ones most likely, to help support you with decision making rather than having social workers get involved in managing your affairs, your care and your medical treatment. So lasting powers of attorney and wills are really important. Now the bit you've been waiting for, making tax digital, my favourite topic. And as an accountant in practice, I have considered retirement over this issue. Many colleagues are retiring because it's going to be awful helping clients get through this transition. What does it mean? If your rental income, not your profits, but the actual rents, are more than £10,000 per year, you must do this. And it's coming in really soon. And most clients struggle with one tax return per year. Under making tax digital, it's 6 tax returns per year. And I still have clients who like to use shoe boxes as an accounting system, a shoe box full of paper. Not acceptable. We have to have computer records, not optional. And it's not very far away. The government, whoever that might be soon, who knows, they have kicked this can down the road once already, but it's only a year and a half away, and I would suggest everybody here this evening needs to be getting on and getting this put in place. And you've probably seen lots of adverts on the television and the radio from all of the software companies who are clearly having a wonderful time now that many people need to purchase accounting software who didn't previously, but it's just something we have to get on and do. Spreadsheets are acceptable for the time being, but in the longer term, in my opinion, it's going to be accounting software based. Now, this is another piece of speculation, but I think it has a big effect on landlords' cash flow. Most of you here are used to a biannual system of tax payment. You pay your balancing charge and first payment on account at the end of January, and then at the end of July you make your second payment on account. So you pay your tax twice a year, and you pay that tax quite a long time after you earned the income on which that tax has been charged. Now let me think, why do I think that HMRC want us all to file quarterly tax returns? Why might that be?
Increase their cash flow.
So, first of all, they're shifting workload from HMRC to the taxpayer, because we'll do a lot more work in producing these records for them. And secondly, what might I do if all the taxpayers are filing quarterly returns and I want to try and find 40 or 50 billion to plug a big hole in the public finances? So in your cash flow planning, as an accountant, I would urge caution in difficult times, but think about just 1.5 years from now, we'll have Making Tax Digital, and possibly, speculating here, you may have almost real-time tax payment following shortly on. So if that was all interesting and you'd like to get some help, we can help with self-assessment tax returns, Making Tax Digital, capital gains tax, wills, lasting powers of attorney, and any other financial matters you might wish to have some assistance with. And we're not as scary as people think. I often have prospective clients who are scared to come and meet an accountant because they think they're going to be horrible people, and we really aren't. And it's important to get the advice that you need. And if anybody, having seen my presentation, would still like to get in touch, my details are on the screen. And thank you all so much for your attention. It's been a pleasure speaking for you. Thank you.